Welcome to my channel Crypto News. Cryptocurrencies have been enormously volatile since being introduced, but that volatility can create opportunities for profit if you're looking to trade these digital assets. Cryptos such as Bitcoin and Ethereum have risen a lot since their debut, but are down significantly from their highs along with other popular digital currencies. Experienced traders have been speculating on cryptocurrencies for years, but how can you get started if you're new to the crypto market? 5 steps for investing in cryptocurrency. First things first, if you're looking to invest in crypto, you need to have all your finances in order. That means having an emergency fund in place, a manageable level of debt, and ideally a diversified portfolio of investments. Your crypto investments can become one more part of your portfolio, one that helps raise your total returns, hopefully. Pay attention to these 5 other things as you're starting to invest in cryptocurrencies. 1. Understand what you're investing in. As you would for any investment, understand exactly what you're investing in. If you're buying stocks, it's important to read the annual report and other SEC filings to analyze the companies thoroughly. Plan to do the same with any cryptocurrencies, since there are literally thousands of them, they all function differently and new ones are being created every day. You need to understand the investment case for each trade. In the case of many cryptocurrencies, they're backed by nothing at all, neither hard assets nor cash flow. That's the case for Bitcoin, for example, where investors rely exclusively on someone paying more for the asset than they paid for it. In other words, unlike stock, where a company can grow its profits and drive returns for you that way, many crypto assets must rely on the market becoming more optimistic and bullish for you to profit. Some of the most popular coins include Ethereum, Dogecoin, Cardano, and XRP. So before investing, understand the potential upside and downside. If your financial investment is not backed by an asset or cash flow, it could end up being worth nothing. 2. Remember, the past is past. A mistake that many new investors make is looking at the past and extrapolating that to the future. Yes, Bitcoin used to be worth pennies, but now is worth much more. The key question, however, is will that growth continue into the future, even if it's not at quite that meteoric rate? Investors look to the future, not to what an asset has done in the past. What will drive future returns? Traders buying a cryptocurrency today need tomorrow's gains, not yesterday's. 3. Watch that volatility. The prices of cryptocurrencies are about as volatile as an asset can get. They could drop quickly in seconds on nothing more than a rumor that ends up proving baseless. That can be great for sophisticated investors who can execute trades rapidly or who have a solid grasp on the market's fundamentals, how the market is trending and where it could go. For new investors without these skills, or the high-powered algorithms that direct these trades, it's a minefield. 4. Manage your risk. If you're trading any asset on a short-term basis, you need to manage your risk, and that can be especially true with volatile assets such as cryptocurrency. So as a newer trader, you'll need to understand how best to manage risk and develop a process that helps you mitigate losses. And that process can vary from individual to individual. Risk management for a long-term investor might simply be never selling, regardless of the price. The long-term mentality allows the investor to stick with a position. Risk management for a short-term trader, however, might be setting strict rules on when to sell, such as when an investment has fallen 10%. The trader then strictly follows the rules so that a relatively small decline doesn't become a crushing loss later. Newer traders should consider setting aside a certain amount of trading money and then using only a portion of it, at least at first. If a position moves against them, they'll still have money in reserve to trade with later. The ultimate point is that you can't trade if you don't have any money. So keeping some money in reserve means you'll always have a bankroll to fund your trading. It's important to manage risk, but that will come at an emotional cost. Selling a losing position hurts, but doing so can help you avoid worse losses later. 5. Don't invest more than you can afford to lose. If you can't afford to lose it, all of it, you can't afford to put it into risky assets such as cryptocurrency, or other speculative assets, for that matter. Whether it's a down payment for a house or an important upcoming purchase, money that you need in the next few years should be kept in safe accounts so that it's there when you need it. And if you're looking for an absolutely sure return, your best option is to pay off debt. You're guaranteed to earn, or save, whatever interest rate you're paying on the debt. You can't lose there. Ways in investing in crypto. 1. Buying crypto outright. The most straightforward way to gain exposure to cryptocurrency is by investing in the coins you're interested in. This is most commonly done via a traditional investment platform or crypto exchange. There are some unique aspects to this strategy. For example, buying crypto outright gives you exposure to the industry in as little as minutes. Entering an order on a traditional investment platform or an exchange can also provide hands-on experience on the buying process, which can be useful for better understanding how crypto works. Buying crypto outright may give you complete custody over your coins, which allows you to transfer coins between wallets, i.e., personal crypto accounts. This may make it easier to understand how blockchain technology works. And because the markets are open 7 days a week, there's more flexibility to decide when you want to invest compared to traditional assets like stocks and ETFs. 2. Buying crypto-related ETFs on a brokerage platform. Crypto-related exchange-traded funds, ETFs, give you exposure to a diversified basket of cryptocurrency values without actually owning any cryptocurrencies. Note that these ETFs are based on crypto futures and crypto stocks, and are not direct crypto ETFs. ETFs that track the broader industry may offer less volatility compared to buying individual coins. Investors who believe blockchain technology may become an economic force might find it easier to invest in a single ETF, as opposed to buying individual coins and companies. With that said, ETFs don't give you ownership of actual cryptocurrencies, which means they can't be used to pay for goods and services. Also, because ETFs are portfolios made up of multiple investments, the upside associated with individual cryptocurrencies or associated companies can be diluted. If a specific coin or company appreciates in value, you may not be able to capture the same level of growth by holding an ETF. 3. Buying cryptocurrency stocks. Another way to invest in crypto is by buying individual stocks of companies in the crypto industry. Examples include crypto exchanges, Bitcoin mining companies, and banks that provide solutions for crypto companies. Crypto stocks offer a way for investors to bet on which companies will lead the industry. And while buying crypto on an exchange incurs trading fees, most major brokerages offer trading for both stocks and ETFs with zero commissions. Note that ETFs may still have management fees. However, inexperienced investors should be aware this strategy has its risks. Crypto's inherent volatility, poor earnings reports, negative industry trends, and other factors can all cause a stock's value to plummet. Less experienced investors may not want to put all their eggs in the same basket, in which case crypto-related ETFs may be a preferable option. These are the steps on how to invest in crypto as a beginner. Kindly like, comment, and subscribe on my channel Crypto News. Thanks.